Hi, I'm Stacy Burke from Stacy Burke Trading. Would you like to create a consistently successful trading plan for the market? Stay tuned, we're going to go over this next. Hi, I'm Stacy Burke from Stacy Burke Trading. Today we're going to go over 4 key components to creating a successful trading plan. Now, it's the old axiom, if you fail to plan, you're planning to fail. And if you're serious about trading and you're serious about being consistently successful in the markets long term, you need a business plan. And with trading, that comes down to your trading plan. I'm going to go over some key aspects today. Use this as a guide for building your own trading plan. If you haven't got one already, I'll encourage you to do so. Take some ideas from mine, add to it if you like. I think that you're going to get the core key components that are maybe some things you might not have thought about, but also some things that might fill in some gray areas and also give you some clarity in terms of how you can expand that and get very detailed. I think a master is always focusing on finer detail. So let's get started. First thing, basically we're looking at methodology, money management, mindset and psychology, and your tools. So personally, I think that the money management is the most important aspect of your trading plan, but we're going to go through the methodology first just for simplicity. So first thing you want to decide, if you haven't done so already, is what type of trading system are you going to have? Is it going to be trend following, mean reversion, a counter trend system, a range bound trading system? These are all things that you'll need to decide in terms of how you're going to actually be trading your system. So the second component of that is the instrument. Are you trading index futures, commodities, oil, metals, currency futures, interest rates, shares? Again, you'll find that often a profitable system, people will take a system and think they can trade it on any instrument, and that's not necessarily the case. You want to make sure that whatever market you're trading your system on, you've done your back testing, your forward testing, and you've got your positive expectancy in the instrument that you're actually trading. So second part of that is you need to know which instruments you're going to be trading with your system. Number 3, time frame. Are you going to be trading intraday, 5-minute charts, hourly charts, 4-hour charts, end of day? My trading system predominantly is an end of day model, so I check that on a 24-hour rotation. But if you're going to be day trading, is it going to be around the market opens? Is it going to be around the London Open? Is it for the bulk of the index futures trading session? These are all things that you'll need to decide how you're going to be trading that based on your own situation. So time frame is number 3. Now, what type of criteria are you going to be taking your entry orders on? So is it going to be longs only? Are you going to be buying and selling or shorting the market? Is it a long and short system? So you're going to need some parameters so that when you do get an entry signal, you want to not have analysis paralysis. So it looks great in back testing, but when you actually get the live signal, have you got like 7 different indicators where all of a sudden you've got analysis paralysis and you can't decide if the market's actually going up or down. So you want some real simple, clear-cut rules. I don't remember who said it. It was an old trader from the floor, and they said if you can't write your trading plan on the back of an envelope, then it's too complicated. So you should be able to write it down in a real simple sentence. When A happens, I will do B. And that's part of where you want to get your system to, because it's about flawlessly executing your trading process. And the simpler that you can make your rules and your parameters for entries and exits, whether they're long or short, the better, and the more consistently you're going to be able to follow the trading process itself. So where your stop loss is going to be placed, is it going to be purely based on a percentage of capital? Is it going to be a technical stop based on the distance from your entry, 1 ATR or 1 R risk? These are all parameters you'll have to decide upon in terms of when your entry orders are triggered, where will your stop losses be placed? I never put an order into the market without a corresponding stop loss order at the same time, and we'll get to that later. Indicators. Are you going to be using any types of indicators? Stochastics, moving averages, Bollinger Bands? Are you using anything that needs to be part of that entry-exit signal generator for your signals when your trading system gives you those? So I have one indicator that I use, but mainly it's price action based. I look at a momentum indicator, but it's a secondary support tool for me based on price action first and foremost. So those are things that you'll need to decide upon for your methodology. Number two, money management. Most critical part of your trading plan is your money management, because unless you understand your risk of ruin, chances are you're going to be like the other 95 to 98% of traders that are estimated to lose money. You're going to have a risk of ruin above zero, which we'll get into this a bit more in detail later, but essentially what that means is that if your risk of ruin is above zero, you're going to run out of capital at some point and blow up your trading account. So from there, you'll need to have position sizing that coincides with your stop loss. So is it a capital-based stop loss? Is your position sizing going to be, a 0.5% of your trading capital on each and every trade? These are all things you'll need to understand so that essentially you're not destroying your trading account if you go into a drawdown or into a successive number of losing trades in a row. How much capital do you have to start to trade with? Is this a small percentage of your overall capital? How much of that are you willing to risk? And how much of that are you willing to lose if you head into a drawdown or a negative phase of trading? The key component is sticking to this part of your plan, because if you lose some money and then all of a sudden you want to double up on the next trade, or you want to take revenge on the market, you've completely lost your focus on following your trading plan, and all of a sudden you've doubled up or tripled up on a trade to try and get even on a loss, you're going to blow up your account. So you need to decide at how much of that capital in your trading account that you're willing to lose before you decide, okay, I obviously don't know what I'm doing, or I need to stop trading. And I've done that to myself. At some point you need to sit back and go, hold on a second here. What I'm doing right now is gambling, it's not trading. Shut the computer off, you need to walk away, and you need to reestablish your frame of mind before you can return to the screen, because you'll destroy your trading account and your risk of ruin you'll blow up. And if you're not in the game, you can't win it. So this is critical. If you haven't read Brent Penfold's book, The Universal Success Principles of Successful Trading, become a great loser, become really good at losing, taking small losses consistently. Just become really good at taking losses when they come. The best loser wins. So on the other side of that, if you're consistently generating profits, have a plan for what you're going to do with those profits. Are you going to take some out every week, every month? How much are you going to take out? What are you going to do with it once you've taken it out? Are you going to pay some bills? Are you going to put it on your home loan or a mortgage? Are you going to take your wife out for dinner or your husband out for dinner? Take a holiday, whatever it is, but have a plan for that in place. Okay, so that brings us to the third component, which is mindset and psychology and journaling. You want to be keeping accurate records of your trading history. So obviously keeping track of your profit and loss, your entry and exit, in terms of your following the trading process, but also your frame of mind. What did you do well today, or what did you do well this week? What were your strengths? What were your weaknesses? Where were your mistakes made? It's an opportunity for you to go back and review things and keep a history of things. And when you see it and you hear it and you write it down, you're reinforcing that 3 times to the nervous system. So it's really critical to know that you've done some things well. What could you have done better? What type of frame of mind were you in? And one of the things, if you haven't done so already, go to my homepage, enter your name and email, get my 7-step daily routine for high-performance traders. That's all about creating confidence, discipline, and a winning mindset for traders. It's about creating a morning routine that not only is for physical health and well-being, but your mindset, accelerated learning, 30-day goals. It's all about building a plan that's consistently working for you week in and week out forever. And You know, I get up early and I go over my routine almost every single day. Well, I do it every single day. I don't miss a day. And if you want to be great at something, you can't miss a day. You work at it every single day. And that's where the journaling comes in. It reinforces you following the trading process, following along where you're making the successes or where you're making the failures. Where can I correct that? You got to focus constantly on the things that you can control, not the things that you can't control. The market going up and down, you can't control that. But what you can control is flawlessly executing your trading system and your money management. So if you're following those rules and you're keeping accurate records and your system has a positive expectancy, you're going to have a positive, successful situation in the market over time. Now again, you've got to constantly be monitoring that, because maybe the markets are changing, maybe your system's losing its edge. But that's where the journaling comes in. And you've got to be keeping check on yourself. One of the hardest things about trading is that you're doing it by yourself. You don't have anybody, a risk control person, coming in and tapping you on the shoulder and saying, hey, you're over your limits, or hey, you're not taking the proper signals, or hey, you've drawn your account down too much, or hey, you look hungover today. You shouldn't be here. You have to be the risk officer in your own office. The only way you're going to survive in this industry is by sticking to the trading plan, and even the best of the best are only one trade away from destroying themselves. And as soon as you understand that part of it, you understand how important it is to become a good loser. But start journaling, keep accurate records, get the 7-step daily routine for high-performing traders. I guarantee you, if you follow that process, even at 50%, you're going to see a lot of positive changes in your life and in your trading. Number 4, tools. Get a good computer, make sure it's fairly new, stable, not cluttered up with a lot of junk and emails and pictures and videos and all this other stuff. Try and have a designated computer that's purely for trading. I run a malware scan on mine every few days, but I just constantly keep it running smooth and clean. You want to have an alternate power source, or in case your internet goes down, be prepared for that contingency, the lightning storm, whatever it is. I can assure you it's probably going to happen, because it's happened to me several times. The internet will go down, that's just how it is, so be prepared for that, which means you always trade with a stop in place. And have an alternate phone. So if you're on a landline or a cell phone, make sure that you've got access to a second phone in case there's a problem and you need to call your broker, getting out of a trade, putting a stop in place, taking profit, whatever that may be. You want to be prepared for that situation. If you're prepared for those emergencies, it's the less likely that they're going to happen. But you don't want to be in the market with a stressful position and all of a sudden power goes out, you don't have a stop, and it's just before a news announcement or something ridiculous like that. So be prepared, and I guarantee those situations probably won't arise very often. I hope this gives you a good framework to build your own trading plan on. I'm sure I've left some things out, but just going over some really key components. Take some of those things, put them in your own trading plan, make it suit your situation and your lifestyle and your particular circumstances. Test it all out, go over it, and it may change with time. You might just keep tweaking that, but I guarantee if you type something out and you have a plan, you're going to feel better about your trading. You're going to be running it more like a business, and then the business of trading is going to start to treat you like a professional as well. I hope this has been of help. If you like it, please share it on Facebook. I'd appreciate some of your comments below. Always trade in your own best interest. May the markets go with you, and stay disciplined. I'm Stacy Burke.
Hi traders, I hope you found today's video interesting and informative, and I hope it gave you some valuable insights into making your trading simpler and more productive. If you haven't done so already, please come by my blog, stacyburketrading.com. Sign up for my free audio MP3, the 7-step daily routine for high-performance traders. This is essential knowledge for all traders in all markets, and is designed to help traders to master the market with disciplined confidence and a winning mindset. Please like this or share it on Facebook, and I would love to have some feedback. Any questions or comments, please put below. May the markets go with you, and always trade in your own best interest.